Good afternoon. I will call to order this remote hearing of the House Commerce Committee and ask Mr. Dockendorf to please take the roll.
Chair Stevenson,
Present.
Vice Chair Kotisa-Wittun,
Present.
Representative O'Driscoll, Representative Barr,
Here.
Representative Carlson,
Carlson present.
Representative Davney,
Dabney present.
Representative Elkins, Representative Haley,
Haley present.
Representative Kegel,
Present.
Representative Lee,
Lee present.
Representative Lilly, Representative Listlegard,
Listler present.
Representative Lucero,
Zero here.
Representative Olson,
Present.
Representative Farr, Representative Rasmussen,
Rasmussen present.
Representative Richardson,
Present.
Representative Tice. Chair, we have a quorum.
Thank you. We do.
Elkins is present as well.
Our first item of business is approval of our minutes from March 30th, 2022. Vice Chair Kotisa-Wittun, do you have a motion?
Thank you, Mr. Chair. Yes, I would move approval of the most recent copy of minutes that Mr. Brown sent out. There was a testifier missing on an earlier copy that we made the correction for.
All right. Representative Kotisa-Wittun moves the adjusted minutes from March 30, 2022. Any discussion to that motion? Seeing none, all in favor, please say aye.
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 Opposed? The motion prevails and the minutes for March 30, 2022 are approved. Members, we have two bills on our agenda today. The first bill, House File 4651, is the governor's recommendations for the Department of Commerce budget. We will go through that bill first, take some testimony on the bill, and then we will move to discussing the draft Commerce Omnibus Bill. We will have nonpartisan staff explain that bill today. We will take any member questions as to the bill. Then tomorrow, we will mark up the bill and vote out the bill, and we will also look at some late coming liquor issues that have popped up. But first, we will take a look at House File 4651, which I will move before the committee. This, as I mentioned, is the governor's recommendations for the Department of Commerce, and I will hand the floor, therefore, to the Commissioner of Commerce, Commissioner Arnold. Welcome back to the committee, Commissioner Arnold.
Good afternoon, Chair Stevenson and members. For the record, I'm Grace Arnold. I'm the Commissioner of the Minnesota Department of Commerce, and I'm joined today by our Assistant Commissioner for Government and External Affairs, Peter Brickwady. Peter is hopefully going to send up some slides to walk through the budget. All right, you want to hit the presentation mode? Sorry, we're sitting in. All right. So thanks for the opportunity to provide a high-level overview of the department's supplemental budget items, and thank you, Chair Stevenson, for introducing the bill. While it's not reflected in the House file, our supplemental budget bill was made a little bit shorter last week, thanks to the hard work of Chair Stevenson, Representative Kotisa-Wittun, Representative O'Driscoll, and the rest of the Reinsurance Committee who passed the bipartisan conference report on Thursday. So thank you all for the work on that. I thought I'd take a moment to do a quick review of what the department does as a refresher for the committee and to help orient you to the items that you'll hear later today. At Commerce, our mission is to protect all Minnesotans in their everyday financial transactions by investigating and evaluating services and advocating that the services be fair, accessible, and affordable. What are those services? We protect Minnesotans in their everyday financial transactions in the following areas: financial institutions, that's banks, credit unions, non-depositories, which include mortgage originators and student loan servicers, insurance, enforcement, licensing, unclaimed property, senior financial fraud, consumer services, energy resources, telecommunications, and the Petro Fund. At its heart, Commerce is a consumer protection agency. The department's regulatory authority extends across a large sector of Minnesota's economy by conducting investigations and examinations, responding to complaints, and issuing professional licenses and advocating on behalf of the public interest. So with that orientation, I'll move to the governor's budget items for the department. This supplemental budget makes additional investments in a couple of key areas of the department. And these budget items will allow for additional or improved services to consumers and businesses across Minnesota in our administrative services, insurance, enforcement, and financial institutions divisions. So the first item I'd like to present is the senior financial fraud staffing. As a reminder for many of you were around, but as a reminder in 2018, the legislature enacted a new law that allowed financial advisors and broker dealers to report suspected financial fraud involving seniors and vulnerable Minnesotans to the Commerce Department. In 2020, the legislature expanded this law to include banks, credit unions, and other financial institutions. In response to increasing referrals stemming from the 2020 changes, Commerce dedicated a staff position solely to responding to consumer complaints, working case files involved in reporting financial fraud targeted at seniors, and conducting outreach to community and industry to raise awareness of the new law. While these efforts have been successful, Commerce is seeking $127,000 in additional funding for a second FTE in this unit to support the work moving forward. This will allow not only for more action on referrals, but also proactive outreach as the department continues to combat senior financial fraud. The next item I'd like to talk through is insurance division staffing. During my time as commissioner, I've focused not only on protecting consumers, but also in hearing from our regulated entities about how the department can better meet their needs. This budget item is a result of hearing from the insurance industry that they would benefit from having a senior manager within the insurance division that not only can focus on forms and filings, so approving products for sale, but also have expertise in emerging products and trends in the market. Commerce is seeking an additional $180,000 in additional funding for one FTE for this role. Market conduct staffing is another item that relates to my efforts to improve processes within the department to better serve Minnesotans and our regulated entities. We're seeking $345,000 for additional funding to hire 3 new in-house market conduct exam staff in the enforcement division. This is a longstanding ask by the insurance industry, and Commerce believes this funding is essential to build upon internal process improvements and hopefully resolve some lingering issues related to market exams that have been brought forward. I will note that the department continues to work with the insurance industry on reaching consensus language on market conduct policy, and we'll continue that work with industry. The next supplemental budget item is in response to the January 2020 Office of the Legislative Auditor special review of the Commerce Fraud Bureau. We've put in place the operating procedures and practices recommended by the OLA report, and we're now seeking the recommended statutory changes that would authorize the Commerce Fraud Bureau to investigate other fraud allegations that are within the purview of the department's regulatory duties and identify an appropriate funding source for those additional investigatory activities. The department is seeking $174,000 for an additional special agent funded by the general fund to conduct this work. The department is committed to working with the insurance industry on appropriate statutory language and guardrails that would come with this additional funding. Finally, our final proposal is the financial institution division's assessment fee equity. That division's mission is to protect Minnesota consumers, maintain active financial markets, and ensure access to diverse and healthy financial services. The division charters, licenses, and examines Minnesota financial institutions to ensure compliance with the law and financial strength. That division regulates over 210 state chartered banks, 67 state chartered credit unions, and more than 15,000 non-depository licensees. Combined, these companies represent more than $77 billion in assets and tens of billions more in remittances and mortgage originations. Currently, only 431 companies pay into the special revenue fund that funds that division's work. Minnesota statutes currently don't allow for the assessment of all businesses that are regulated by that division. State chartered banks and credit unions, as well as motor vehicle finance companies, industrial loan companies, and debt management companies are currently assessed. However, several non-depository businesses, including money transmitters and mortgage originators, are not assessed. This results in assessable businesses paying for the oversight of non-assessable businesses. The department is seeking to address this issue by extending the assessment authority of the Financial Institutions Division to include all of the regulated entities under that division's purview. This would result in a redirection of $783,000 in fee revenue from the general fund to the special revenue fund that funds that division's work. And that completes my overview of the supplemental budget recommendations. And I am happy to stand for questions. If you have any questions, not right now, feel free to contact John too.
We do have one additional testifier, and Commissioner, I don't know, I understand your time is a little bit limited today. I don't know if you can stay on through that testifier, and then we can
Yep.
take questions.
Yeah, I
okay.
can do that.
Let me get my, sorry, I misplaced my document here. The second testifier is Bill Schweitz of the Minnesota Mortgage Association. Schweitz, I expect. I'm sure I said that wrong.
Good catch. Yeah, this is Bill Schweitz with the Minnesota Mortgage Association. Thank you, Chairman Stevenson and committee members. Thanks for the opportunity to speak on House File 4651. As you know, many member companies of the Minnesota Mortgage Association are regulated by the Financial Institutions Division of the Minnesota Department of Commerce. The Minnesota Mortgage Association, or the MMA as we call it, favors a stable and properly funded state regulator. The MMA has always supported and is glad to see that this bill includes the redirection of fees from the general fund to the Financial Institutions Special Revenue Fund. We believe that licensing, examination, and other state regulatory fees paid by our members should go to fund our regulator directly rather than going to the general fund for other purposes. In addition to the fees paid by our members, this bill proposes to assess state regulated non-depository institutions. The Minnesota Mortgage Association does not necessarily oppose assessing these state regulated member companies because, as stated earlier, we favor a stable and properly funded regulator. We, however, have reservations about the broad sweeping powers that are given to the department in this bill. In House File 4561, Section 3, Subdivision 2, assessment authority is given to the department without restraint and allows the department to assess whatever the department wishes. The department has said that assessing mortgage companies and other regulated financial institutions is necessary to prevent the assessable businesses from having to bear the cost of regulation for the non-assessable businesses. Well, a few years ago, legislation was passed to redirect mortgage industry fees, again, those licensing fees and examination fees, redirecting them from the general fund to the special revenue fund. Recently, we were told by the department that the fees that have been collected and directed to the special revenue fund currently exceed the cost of regulation for the mortgage industry for this year and possibly future years. This could cause us to ask why the department even needs this assessment in the first place. However, we understand that things can change and that it is reasonable for the department to have the authority to assess mortgage industries when needed, as long as there are safeguards for the industry. In order to protect private businesses and to improve transparency and fairness, it would be appropriate for the bill to be amended to adopt some or all of the following practices. And these following practices are common in other states that assess mortgage lenders, as is proposed in this bill. We could require an advisory board to review the department's budget goals, staffing, and assessments. The advisory board would be made up of department personnel and regulated companies of the mortgage industry. Another practice is to put limits on the minimum and maximum amount that can be assessed when needed, or have an established and published factor which can be multiplied by the appropriate number of mortgage loans or dollar amount originated, and use NMLS data when calculating assessment so as not to require the burden of additional reporting. In addition to the lack of restraint in this bill, there are some ambiguous statements that could allow for inconsistent or unfair interpretation. And we would ask that the bill be amended to clarify line 5.2, subdivision 4, general assessment basis. There it reads, assessments shall be made by the commissioner against each institution within the industry on an equitable basis according to the total asset or business volume of each institution. We need to ask, what is meant by industry? Does that include all financial services companies, or is that just mortgage companies, the mortgage industry, the mortgage servicing industry? And will this definition of industry be consistent from year to year? And what is meant by equitable? As we all know, company types vary even within an industry. And how is the proportionate share of the cost of regulation for each industry determined? This needs to be transparent in order to be for assessments to be fair. In addition, there needs to be clarity on what is meant by total assets or business volume. Does that mean mortgage originations, a mortgage servicing portfolio? And does business volume include all loans or just loans done in Minnesota? So it's understood that this bill was written to cover other regulated industries beyond mortgage lenders, but there needs to be a balance between broad, inclusive policy statements and important protections for private businesses. In closing, I would like to acknowledge that the Minnesota Mortgage Association and the Department of Commerce Financial Institutions Division have always maintained a really good relationship. We respect and trust the individuals at the department, and I hope they feel the same of us. Unfortunately, times can change and people can move on and old relationships can be forgotten. So therefore, the Minnesota Mortgage Association cannot support the assessment provision in this bill as currently written. It is important that any assessment authority that is given to the department also include protections for private businesses now and in the future. Chairman Stevenson, committee members, thank you for your time and attention to this matter.
Thank you for your testimony. We had no other testifiers sign up to testify as to this bill, so we'll move to member questions and discussion. Are there any members wishing to discuss the bill or ask questions? Seeing none, I will say thank you again to Commissioner Arnold and the Department of Commerce for appearing today. I don't know, Commissioner, if you have any closing comments you'd like to make.
Just to thank the committee for the time and to thank you all for your consideration. If you have any questions or you want to talk about any of the provisions, we're happy to talk with you. Just reach out to John.
Thank you again. And with that, I will lay over House File 4651. Next, members, we will move to House File 3607, which is our vehicle bill. We have posted a delete everything amendment to the bill to transform it into the Commerce Omnibus bill. In a minute, I will have House Research and House Fiscal walk through the components of the bill. I'll just say at the outset that I appreciate the good work of all members of this committee in doing the work on this bill. I think we have a very good and balanced bill before us. It includes measures from both the majority party and the minority party. There's a lot of good policy in this bill. The thing that I would add on top of that is that in this committee, we have had the practice of sending bills out to the general register, I think more so than some of our other committees here in the legislature. And I don't want members to think for a moment that just because we've included a bill in the omnibus, that it isn't ripe and ready for floor action. I still prefer to see bills proceed standalone whenever possible. And I have had communications with leadership to the effect that bills that we are including in our omnibus is only for a belt and suspenders approach, and that we still hope that those bills can travel as standalones, and I expect that many of them will. So with that caveat, we will have nonpartisan staff walk through the bill, and then we'll take member questions. So first, we'll ask our excellent House Fiscal Analyst, Ashley Eng, to walk through the fiscal components of the bill. Ms. Eng.
Hello. I'll share my screen. Can everyone see it?
We sure can.
I'll be looking at the 2022 Commerce Omnibus columns, starting on line 3. The total general fund impact for fiscal year 2023 is $6,820,000 and $5,846,000 in the tails. That includes total spending and revenue impacts. And on line 7, there is the financial institutions assessment equity revenue impact. And on line 12, the total spending for the general fund is $6,037,000 in fiscal year 23 and $4,280,000 in the tails. Looking at the items on line 13, there is $233,000 in fiscal year 2023 and $406,000 in the tails for the student loan advocate. On line 14, there is $3,700,000 in fiscal year 23 towards the auto theft prevention program. On line 15, there is $870,000 in fiscal year 2023 and $1,622,000 in the tails for the additional peace officers. On line 16, there is $108,000 in fiscal year 2023 towards health insurance geographic area study. On line 17, there is $300,000 in fiscal year 2023 and $600,000 in details towards the financial institution division's additional security staffing. Looking at line 20, in fiscal year 2023, there is $301,000 and $602,000 in the tails towards the senior fraud prevention program. And on line 22, there is $525,000 in fiscal year 2023 and $1,050,000 in the tails for the insurance division staffing. That is all the general fund items. And lastly, on line 26, there is a special revenue appropriation of $500,000 in fiscal year 2023 towards the auto theft prevention account appropriation. And then additionally, there is the financial institutions equity assessment equity on lines 30 and 33. That concludes my presentation.
Do members have questions for Ms. Eng? Seeing none, we'll turn to House Research and Lori Pompu to walk through the rest of the bill.
Chair and members, I am happy to do a walkthrough. It will not be as brief as Ashley's walkthrough, but hopefully informative. Article 1 is the appropriations, which Ashley just covered. So we're going to start in Article 2, Commerce Policy. Section 1 creates an authorization that the Commerce Fraud Bureau's primary jurisdiction is offenses with a nexus to insurance-related crimes or investment fraud. It allows the Commerce Fraud Bureau to respond to a law enforcement agency's request to exercise their duties with the agency that has primary jurisdiction, meaning the Commerce Fraud Bureau can work with law enforcement agencies whose jurisdiction is outside of the Commerce Fraud Bureau's primary. Section 2 requires the Commerce Fraud Bureau to take actions within its primary jurisdiction. Section 3 defines live course for purposes of continuing education credits for professions regulated by the Department of Commerce. Section 4 defines on-demand course for the same purposes. Section 5 lists the requirements a proctor must meet for continuing education, for giving examinations related to professions that the Department of Commerce regulates. Section 6 defines professional designation. Section 7 defines on-demand continuing education requirements, and it lists out the technological and structural requirements that an on-demand course must meet. It also provides that a final examination has to be encrypted online, or it has to be a monitored paper exam. Section 8 makes changes to requirements a person must meet to be approved by the commissioner as a course coordinator. Section 9 makes a technical correction. Section 10 relates to the assessment authority that was discussed by the Commissioner of Commerce. It changes the assessment authority to include all financial institutions, excluding student loan servicers and collection agencies. Sections 11 allows the commissioner to make assessments on financial institutions based on their business volume as well as total assets. Section 12 deposits funds received from assessments on all financial institutions into the financial institutions account versus the general fund. Section 13 requires financial corporations to file their proposed articles of incorporation with the Commissioner of Commerce. Section 14 requires financial corporations to file their certificate of corporation with the Commissioner of Commerce. These are both changing the Secretary of State to the Commissioner of Commerce. Section 15, Certificate of Authority, it makes conforming changes regarding filings made by financial corporations with the Commissioner of Commerce. Section 16 makes conforming changes again. 17 makes conforming changes again. All filings regarding financial corporations will be made directly with the Department of Commerce versus to the Secretary of State with a copy to the Department of Commerce, which is the current policy. Section 18, conforming changes. Section 19. This requires assessments against a trust company or state bank and trust to be deposited in the financial institutions account. Section 20 requires assessments against an industrial loan and fifth to be deposited in the financial institutions account. Section 21 requires money collected by the commissioner under Chapter 53 to be deposited in the financial institutions account. Section 22 involves a sales finance company, and again, it deposits those funds in the financial institutions account. Section 23 makes a technical update. Section 24 involves all money collected by the commissioner under Chapter 56 regulated loans to be deposited in the financial institutions account. Section 25 changes the date for the Automobile Theft Prevention Program report to the legislature. It's currently due January 15th, and this will move it to September 30th of each year. Section 26 deals with registration of broker-dealers, agents, and investment advisors, and it makes a technical change. Sections 27 and 28 make technical changes for the operation of the Department of Commerce. Section 29 changes the definition of dealer in bullion products to those who conduct Minnesota transactions, and Section 30 defines what a Minnesota transaction is for purposes of that type of sale. Section 31 makes conforming changes regarding a dealer in bullion products. Section 32, conforming changes for bullion products. 33, same conforming changes regarding Minnesota transactions and bullion products. 34 makes a technical change. 35, conforming changes regarding bullion products. 36 makes a conforming change regarding Minnesota transactions and bullion products, and it changes the amount of transactions within the preceding 12 months that require the registration of a dealer. Sections 37 and 38 and 39 all make conforming changes regarding bullion products. Section 40 relates to real estate appraisers. It allows that a real estate appraiser can provide a minimum damage acquisition report, and that when they do so, they are not engaged in real estate appraisal activity. Section 41, it defines terms related to out-of-state continuing education credit. It lists requirements that a real estate appraiser who takes an out-of-state class must meet in order for those credits to be counted in Minnesota. 42, it clarifies that an appraiser licensed after September 1st, 2021 must complete the course required by this section before their first license renewal. Section 43 removes the ability of the commissioner to establish a fee schedule for use by an appraisal management company. Section 44, licensing disqualifications, preliminary applications, and report. It defines the term state licensor and licensor for purposes of the bill. It requires state licensors to permit individuals to submit a preliminary applications related to a license for the purposes of determining whether a criminal conviction or other misconduct would disqualify them from receiving that type of license or credential. It requires each state licensor to submit an annual report to the Department of Employment and Economic Development that contains statistics about their reports and the outcomes. Sections 45 to 48 make technical changes. These are just a change in federal law citation that we're updating. Section 49 allows an individual debt collector to work from a location other than the licensed business location. It is the work from home provision that we've discussed previously. Section 50, again, allows a debt collector to work from home if all the other requirements related to the regulation of debt collectors are met. On to Section 51, the following sections involve the filing of statements, financial statements with the Secretary of State that are meant to harass the debtor. Section 51 makes conforming changes. Section 52 defines intent to harass. It also creates the system by which a debtor can file a notarized affidavit that a filing is made with the intent to harass them. And it lists out the process for them to file this notice, the secured party to receive notice of this, the secured party to disagree with this statement, and for it to be determined by a court if there is a disagreement about the purpose of these financial filings. Section 53, what constitutes filing, effectiveness on filing. This helps determine priority and when a record becomes effective pursuant to these new rules relating to the intent to harass a debtor. Section 54 relates to common interest communities and homeowners associations. It requires the association to provide notice to unit owners before levying a fine if they failed to pay a prior assessment. It includes what must be included in the notice, what they have to inform the owner of, and it prohibits the accumulation of attorney's fees to the unit owner before the notice period has expired. Section 55 clarifies which laws apply in structured settlement transfers. Section 56 defines assignee for purposes of structured settlement transfers. Section 57 adds a definition to explain how to calculate the interest rate for a structured settlement. Section 58, independent professional advice, adds financial advisor to the list of independent professionals that can be a disinterested party for purposes of a structured settlement transfer. Section 59, structured settlement payment rights, clarifies the definition of structured settlement payment rights. Section 60, transferee, defines transferee. Section 61, conditions to transfer of structured settlement payments right and structured settlement agreements. Adds a requirement that a notice and hearing date be sent out, and the notice be provided to an attorney and financial advisor advising the payee of the situation. It provides what must be included in the notice, what fees can be accumulated, that it has to be expressed as an annual interest rate. It allows the court to appoint an attorney to do an independent assessment of the transfer and advise the court on whether the transfer is fair and reasonable. This section also assigns liabilities for proper transfer of the structured settlement. Section 62, discount rate. Requires the discount rate under a transfer agreement to be under the annual percentage rate of prime plus 5 percentage points, and it describes how to calculate that. Section 63, application procedure for approval of transfer, clarifies the venue and requires the payee to appear in person and provides requirements for what the notice of the hearing must include. This again relates to structured settlement transfers. Section 64, prohibited practices. It prohibits a transferee from representing the payee, intervening in a structured settlement transfer, if not a party, offering incentives or gifts to transfer, communicating excessively, soliciting pays with false check advertisements, or soliciting minors or their guardians. This section provides that violations of these prohibitions are considered violations of the Fair Trade Practices Act and can be enforced by the Attorney General. Section 65, construction, adds a provision on how a transfer can affect life contingent payments. Section 66 is revisor instructions relating to the continuing education credits and live course and on-demand courses. Instructs the revisor of statutes to change the term self-study course to on-demand course and change the term classroom course to live course wherever they appear in Chapter 45. This repeal and Section 67 repeals Minnesota statute section 45.25 subdivision 2A and 14. Again, those relate to regulated professions, continuing education, and online courses. Anything I can answer anyone about Article 2?
Questions on Article 2?
All right, well, Chair and members, let's go on to Article 3, insurance. Section 1 of Article 3, regulatory flexibility. It allows the Commissioner of Commerce to authorize long-term care insurance to be sold as part of a life insurance policy if the policy meets certain requirements. Section 2 makes a technical change. Section 3 removes language regarding a health plan company's duty to disclose information regarding an individual contracted provider's expected reimbursement. This relates to dental services provider contracts. Section 4 makes conforming changes to that previous section. Section 5, healthcare provider contract termination. It allows a health plan company to terminate a provider for cause only. And only if the contract includes an appeal process for the provider, requires notification, and for the health plan company to submit their appeal process to the Department of Commerce or Health, depending on their regulator. And on to Section 6, it defines covered services for purposes of dental care. Section 7 defines third party for the same reason. Section 8 makes a technical change. Section 9, billing for covered services. This lists requirements that a contract of a dental plan, dental organization, or dental provider agreement must include in relation to billing and collecting payments from enrollees. Section 10, network leasing. This section allows a dental organization to give a third party access to a dental provider contract service or discount if certain requirements are met. It allows a dental organization to grant a third party access to these contract services or discounts if certain information is enclosed and certain provisions are included in the dental provider contract. Section 11, method of payment, requires a dental provider contract to include a method of payment for services where no fees incurred by the provider, requires fees to be disclosed to the provider by the dental organization before the contract is executed. Section 12, discrimination based on status as a living organ or bone marrow donor prohibited. This prohibits life insurance, long-term care insurance, or disability insurance carriers from declining or limiting coverage or otherwise discriminating in premiums or other ways against a person based solely on their status as a living organ or bone marrow donor. Section 13 defines cash compensation for purposes of recommending or selling an annuity. Section 14 defines consumer profile information for the same reason. Section 15 defines insurance producer for the purposes of the sections being discussed. Following this 72A 203 to 72A.2036. Section 16 defines intermediary. Section 17 defines material conflict of interest. Section 18 defines non-cash compensation. Section 19 defines non-guaranteed elements. Section 20 defines recommendation, and Section 21 defines replacement. Again, these all relate to the sale of annuities. Section 22, best interest obligations. It requires an insurance producer to act in the best interest of the consumer when recommending an annuity. It requires the insurance producer to meet the obligations regarding care, disclosure, conflict of interest, documentation relating to this. Section 23, care obligation. Requires an insurance producer to exercise reasonable diligence, care, and skill when making a recommendation. This section also provides information to the insurance producers on how they can meet these requirements. Section 24, disclosure obligation, requires an insurance producer to disclose certain information to a consumer before recommending or selling an annuity. The Commissioner of Commerce will provide a form that includes the required disclosures. Section 25, conflict of interest obligations, requires an insurance producer to identify and avoid or reasonably manage and disclose material conflicts of interest, again, in the sale of annuities. Section 26, documentation obligation. It requires an insurance producer at the time of recommending or selling an annuity to provide certain documentation to the consumer. Section 27, application of best interest obligation. It clarifies that any requirement applicable to an insurance producer under the section also applies to all insurance producers who exercise control or all insurers who exercise control or influence in making recommendations, and anyone who receives direct compensation pursuant to this. Section 28, transactions not based on recommendation. This clarifies that insurance producers do not have an obligation to a consumer when they do not make a recommendation regarding the purchase of an annuity, or if the consumer decides to enter into a transaction not based on the insurance producer's recommendation. Section 29, insurer duties. Prohibits an insurer from recommending an annuity to a consumer unless there is a reasonable basis to believe the annuity meets the consumer's needs. This lists requirements relating to how an insurer would assess a consumer's needs and the structure of the insurer's compensation system in relation to annuities. It puts limitations on that. Section 30 makes conforming changes. Section 31 makes conforming changes, defines comparable standards, and in relation to the sale of annuities with respect to broker-dealers, investment advisors, and fiduciaries. Section 32, conforming changes and adjust date. Section 33, conforming changes. This also clarifies that whether corrective action was taken can be considered by the commissioner when determining whether to apply a penalty for a violation. Section 34, duration, requires insurers and insurance producers to make available to the commissioner all the disclosures they made to a consumer, including summaries of oral disclosures related to annuities. Section 35, relationship to other laws, enforcement. This makes conforming changes. Section 36, study and report on disparities between geographic rating areas and individual and small group market health insurance rate. This section requires the Commissioner of Commerce to study disparities in Minnesota's 9 geographic rating areas for the individual and small group health insurance markets, and for the Commissioner to recommend ways to reduce or eliminate the disparities. It lists requirements that the study must include. It allows the Commissioner to contract with an outside entity to complete the report, and it requires the report to be submitted to the legislature by January 1st, 2023. Section 37 involves repealers, one relating to dental provider service contracts and several others relating to the sale of annuities. Are there any questions I can answer on Article 3?
Questions as to Article 3, members? Hearing none.
All right. Article 4, consumer protection. Section 1, student loan advocate. It creates a student loan advocate within the Department of Commerce. It lists the duties of the student loan advocate, including resolving complaints, monitoring current law, and establishing a borrower education court. This also requires a report to the legislature by January 15th in every odd numbered year. Section 2, program described commissioner's duties appropriation. This requires the commissioner to establish a library of equipment to combat automobile-related theft offenses. It requires the equipment to be made available to all law enforcement agencies upon their request for these purposes. Section 3, prohibition on possessing catalytic converters, exception. This section prohibits the possession of a used catalytic converter that is not attached to a motor vehicle under certain circumstances. Section 4, prohibition. This prohibits a person who is not a registered scrap metal dealer from purchasing a used catalytic converter. Section 5, unlawful social media activities. This section defines terms, including social media algorithm and social media platform. It prohibits a social media platform with more than 1 million account holders from using a social media algorithm to target user-generated content at an account holder under the age of 18, with some exceptions. Section 6, credit counseling organizations, debtors. Section 6 requires the commissioner to develop and maintain a document for distribution by debt collection agencies that includes information for nonprofit credit counseling services in Minnesota. It requires a certain disclosure to be written in English, Spanish, Somali, Hmong, Vietnamese, and Chinese. And Section 7, weapons, telephone cloning, paraphernalia, automated sales suppression devices, catalytic converters, and bullet-resistant vests. This section defines catalytic converter possession as a violation. This section defines catalytic converter possession in violation of Section 32(5)(e)(21) as contraband that can be forwarded to the appropriate agency upon a conviction. And that is all of the sections, Chair and members.
Thank you very much, Ms. Pompu. Members, any questions for Ms. Pompu or questions for me as to the contents of the bill? Seeing none, I will reiterate our plan for tomorrow, which is that we will have a markup on this bill. Members should try and get their amendments in promptly as we are still in a virtual format. I will tell you that there are already a number of authors' amendments posted. I was a little busy last week, as members might know, and so we had to make some adjustments earlier this week to the bill. And then after that, we will have a number of liquor provisions that we're hearing on an informational basis. But with no further business before the committee today, we are adjourned.